Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Cut to the Chase. Now, Ukraine and geopolitical risks continue to be the focus. As we now know, Russia recognized two regions in Ukraine as independent states and said to send peacekeepers. The US and Europe, meanwhile, calling it the start of an invasion and imposed sanctions, while Germany halted certification of the Nord Stream 2 gas pipeline. Now, from a market response point of view, though, a few things stood out to us. First is that the S&P 500 entered a 10% correction, though this was part of the market catching up after public holiday yesterday, and the index is still about 2% from the key 4222 support we highlighted earlier this week. Now, this might be a good time to remind ourselves of the long-term context of corrections. In the 2009 to 2020 bull market, for instance, the S&P 500 faced a 10% plus correction 6 times, with the decline from its peak ranging anywhere from 10 to about 19%. Now, interestingly enough, European equities did open lower in response to the headlines, but still ended the day largely flat. And that's a theme that carried over to safe havens like the yen and gold, which did see some safe haven demand, but this was also relatively muted. Now, we spoke about the yen yesterday as one potential hedge against the risk of further escalation. Gold, of course, is the other obvious one to consider. Its main challenge is technical resistance around 1920, based on the previous 2021 high. But if this is firmly broken, a run towards subsequent resistance near about 1950 to 1960, and then $2,000 becomes possible if the new cycle supports it. Now, overall, we believe this context suggests that while geopolitics could very well continue to dominate the headlines, the fact that the S&P 500 is now in a 10% correction and the relatively muted response of European equities and safe havens yesterday cause us to question just how much is in the price. Now, while geopolitics and the Fed still have room to surprise, we'd argue that at this stage, adding a hedge may be more prudent strategy than considering reducing any core long-term equity holdings. Now, with all the focus on Ukraine tensions, I just want to spend a moment on China as well. The Hang Seng sold off not only in response to geopolitical worries, but also a report that regulators had asked state-owned firms to check their exposure to a large private financial services firm. Now, this triggered fears about whether a renewed round of regulatory tightening was in the pipeline. However, we take a more optimistic view and believe policymakers are much more focused now on stabilizing growth. So besides central bank easing, yesterday we also had China's finance minister stating that further tax cuts and stepped up payments to local governments were in the pipeline as part of efforts to stabilize growth. What we'd keep a sharp watch on now is the 2021 earnings season, where any positive surprises or guidance against what is currently cautious consensus expectations could help markets form a more convincing bottom. Finally, I wanted to flag that my colleague Trung is releasing a 2-part Invest Tips podcast where she focuses on how to build strong foundation portfolios so that investors have a strong base for successful long-term investing while leaving room to take advantage of short-term opportunities. So watch out for that and have a listen, but I'll take a pause there. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks again for listening, and we wish you a happy trading day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.